Welcome to the Mind of a Millionaire podcast, where we discuss the habits, routines, and choices that lead to financial independence. Today on the podcast, our October portfolio review meeting agenda. The first Tuesday of every month, every financial advisor gets into one room, now a virtual room, and we discuss the historic returns of our investments. We talk about current economic events, and we talk about what we think investments could do over the next 1 year, 3 year, 5 year, and 10-year period. On today's agenda, we will be talking about emerging markets, inflation, technology, and 2022 Social Security benefits. We also are going to start promoting Denver Wealth Management on this show because now we get thousands of listeners a month, and why the heck not? So you need a financial advisor. You should consider using Denver Wealth Management as your financial advisor because we're super great.
Good plug.
Thanks.
Yeah, absolutely.
Okay.
Oh, right. That was it. Okay.
That was
people pay a lot of money for that ad space, and we got it for cheap.
Yeah.
Zach, you had a big week last week, ran the Boston Marathon, and then went out to New York for your 40 under 40 induction.
I set a personal best in the marathon. I bested my previous time by 26 minutes, which I attribute largely to losing 17 pounds in training, eating a super boring, bland diet, and going from 6,000 feet in Golden, Colorado to sea level. And those three things combined, and about 800 miles, actually 803 miles of running this year, contributed to a very substantial increase in the pace which I can run a marathon. So that was super fun. I can't wait to do another one because training for a marathon is very time consuming, but I can't wait to find something to train as hard as I trained for this marathon. It was a lot of fun.
Would you do another marathon, or was it the Boston Marathon? Was it the atmosphere of being there? And what was that like?
You asked if I would do another marathon or if it was just the appeal of Boston.
Yes, if it was the appeal of the Boston Marathon.
I never had I've done some ultra marathons, and I never really had ambition to do like a road marathon, just because it's like hard on your feet and you're running through a city, versus it's a lot of fun to run on a little trail and run through the trees. So, there's these 6 major marathons, right? There's like, it's Chicago, London, Boston, Tokyo, Berlin, and New York, I think. I'm not sure for sure if New York is in there. And the major marathons are so cool because they have all the professionals are there, and there's a huge prize for winning first place, and people come out and try and set records. And, there was like 19,000 people running this marathon. So I have to say, if I ever got a chance to run any of the other majors, I would probably do it, just because it's such a hootenanny, man. It's unlike anything I've ever done. I would probably do it, but I don't plan on running like many more just normal marathons.
Yeah, normal marathons aren't as fun. Okay, and then from Boston, you went out to New York for your Investment News 40 Under 40 Financial Advisors Award induction ceremony.
Yeah, it was awesome. And if you guys didn't listen to the 40 Under 40 podcast I did, it was largely due to this podcast. So, Denver Wealth Management's a successful business, but there's lots of successful financial advisor businesses out there. The reason we're starting to stand out more and more is actually because of this podcast and the education type things that we do. So we reach a pretty broad market with the webinars we do, the podcasts that we do. And because the theme, I should write this down because I keep forgetting it. It's like educating people. I can't remember the name, but basically the fact that we take time out of our schedule to work with, by doing this podcast, we're working with people who aren't our clients. And by doing that, we're doing something not a lot of other financial advisors are doing. So we talked to some big wigs in the financial services industry about what we think the next 20 and 30 years are going to look like, because presumably most of the people in that room are still going to be there. And it was good. It was cool to do something in New York City. That place is wild. I was there with my 3 kids, my wife, and my mother-in-law. And it was an adventure from start to finish. And I'm excited for the people I met there was super cool. So I'm excited I made some friends that I'm hoping to have conference friends for the rest of my life from that conference I did in New York.
That's awesome. And I know we got to get moving on with the podcast, try and keep this short and sweet. But you mentioned talking about what the next 20 to 30 years look like. If you had to sum that up in one theme, what is it? What do those next 20 to 30 years look like in the industry?
Fiduciary. That was the theme. It's not necessarily my theme, but the theme of the people at the conference was this idea that some financial advisors do things like in commission, and some people are selling annuities, and some people are charging fees. It is probably a model that is going to consolidate around this idea of acting in your client's best interest, and that will probably happen as the old school guys who started in the 80s and 90s retire, and the new school guys who've only ever been fiduciaries start to become bigger and bigger players in the industry. So that was probably the theme, is that the commission advisors are kind of dying off naturally. So is it good to expedite that like the government is trying to do? Or should we all just wait until or should we wait until they retire?
Okay. Important stuff. Fiduciaries are great. All right. Well, let's get into it. Let's get into the education. Last podcast, we talked a lot about China. This is from our September portfolio review meeting. Talked about China and emerging markets and kind of where things are at with that. Would you spend a minute or two talking about, A, well, I guess just recapping what we talked about last month, but B, talking about how that's changed and maybe how our outlook has changed as an investment committee?
Yeah. So if you look at, all financial advisors, all professional investors kind of go through the same training. And the training is based really, I mean, it's wild to say. I mean, the training is based on this one Nobel Peace Prize or Nobel Prize award-winning paper written by Harry Markowitz called Asset Allocation, or I'm sorry, it's called Modern Portfolio Theory. And the idea of modern portfolio theory is that somewhere between 90 and 95% of the return you get over the life of your investments does not come from picking the best stock. It doesn't come from timing the market. It just comes from being allocated to a broad diversification of investments and capturing the long-term return. And that's been everybody's Bible for 50 years. He wrote it in the 70s or 60s. I'm not actually sure when it was written, but
a long time, decades.
A long time. And what happens is the problem with modern portfolio theory is that it looks backwards and says, okay, emerging markets, for example, or fixed income, for example, have had this historical up and down, and they've had this historical return. And what it doesn't account for is what happens when there's a major change in the world. So like, if the last, like a kind of a crazy example, just to kind of illustrate what this would mean. Okay, so let's say that the last 10 years for investing in China has been really, really good, and you made 20% a year in China. But today, China declares war on India. Okay, so from a modern portfolio theory perspective, you effectively just look at the previous 10 years and then use that to extrapolate the next 10 years. But if a major monumental thing has changed that affects the future outlook for China, like, for example, they declare a war on India, the two most populous nations in the world, modern portfolio theory really doesn't have anything to say about that. And what we are discovering is that is a flawed model. Like, at some point you have to dig in to the actual future economic prospects and not just look at the past volatility of investments. And I know that's a lot of like industry jargon kind of talk, but that's what we're talking about in China, because China has had this goal from 2010 to 2020. They had a goal of doubling their per capita GDP, which means like per person, the economic output per person. They wanted to double that. And to double that, they let all these Western companies come in, all this Western money come in, and they dabbled in capitalism for a decade. It worked really well. And now they said, hey, we probably went too far into capitalism. Now we're going to tighten up and be a little bit more like communism. And in the process of doing that, they've been taking money away from private companies and private investors. So what we decided as an investment committee is that we don't want to be invested in China. I mean, we just don't. China's pretty good about saying what they're going to do, saying what they're going to do and then doing what they said they were going to do. And they said the next 10 years, they do not have such ambitions to be as capitalist as they have in the last 10 years. So even though the asset allocation models tell us to keep money invested there, those are just past looking. And we think we're at the point where we have to be somewhat future looking when it comes to the actual opportunity in those markets.
Now, when you say moving away from China, are you talking about moving out of emerging markets and international markets as a whole, or reallocating or finding funds that have heavier holdings in different developing nations and emerging nations?
It's a tricky question, based on asset allocation. We've always had a dedicated sleeve that said emerging markets. So we'd always have like 5% of someone's account or 10%, whatever the number is. And we said, no matter what, we're going to try and find the best investments in emerging markets, even if it's not our favorite place to invest. And what we've decided now is we're not going to say we have to find something in emerging markets. Now, like, for example, there's a great company, and I don't know if I can say great company. This might all get edited. There's an interesting company in South America called Mercado Libre. I'm not saying you should invest in it, but it started out as very similar to Amazon in South America. And now they're actually becoming more of like a PayPal. They're becoming more of like a financial company than a web-based company. They're kind of balancing those two things. Well, Mercado Libre is either a good company to invest in or it's not. And I don't think that we have to say, no matter what, we always have a certain percent dedicated to these emerging markets. So that was a kind of a super roundabout answer, Austyn. So I don't know if that answered your question, but we're saying no to having permanently allocated capital to emerging market companies.
All right, fair enough. And just to wrap this up on emerging and international, what can the average listener, retail investor do to make sure they're allocated correctly, or to at least address this in their portfolios?
Yeah, if you look at past history, the times where America has had bad decades, which America, if you're 35, 20, 25, 30, 35, 40, you've never had a bad decade. Like, we've all been investors for the past, those of us who have invested for the past 20 years. No, I guess that's not true. We've had a bad decade from 2001 to 2010. So that was a bad decade. So I guess if you started 20 years ago, so like if you're 45 and you started when you were 25, your first decade was bad. So what I was thinking is, in times like that, having international investments has been great because that's the only place you've made money. So you just have to be forward looking. I don't know a better way to say it. There's an uncertainty aspect that comes with investing. And if you look at where we are in 2021, and you look at where it seems that companies have the most opportunity to flourish and grow and ultimately return capital to shareholders, it seems like the Western world is very much ahead of the emerging world when it comes to investing in those companies.
Sweet. And this will kind of take us into the next topic of rates and tech and growth. But in the US, a lot of people think that rates are going to go up. When rates go up, companies won't be able to borrow as much. And these big growth and tech companies that surged over the past year and a half, I guess decade, if we want to really open it up, might not perform as well.
There's a more interesting aspect to that too. So what you're saying, yes, that's correct. So like, if you watch the stock market on a day-to-day, week-to-week basis, when interest rates spike, tech companies go down. But that's largely like a temporary phenomenon. Ultimately, the return of the company's stock price is dependent on the success or not lack of success of the business. And if you look at the super big tech companies like Apple, for example, can I talk about companies? I always forget the rules. Apple was a debt-free company into hundreds of billions of dollars. And the only reason they started borrowing money is because of the US's weird rules around repatriating foreign profits. So instead of like if they let's say they earn $1 billion in France, if they bring that back to their headquarters in Cupertino, California, they would have to pay tax on that $1 billion. Well, they don't want to pay tax on the $1 billion. So they leave the $1 billion in France, they borrow $1 billion in the US, and then they don't pay the taxes. So that's the only reason some of these big tech companies are borrowing. It's just for like this financial arbitrage. So I don't know. In the long run, I would think that's not a big deal. In the short term, it's kind of, you'll get a little seasick when interest rates go up. But I also, I challenge the basic assumption too that interest rates are destined just to go up. I mean, if you look at the last 30 years, interest rates have gone from 17% down to where they are now, 1.5%. There's a very good case to be made that interest rates could keep going down. But the more interesting part, if you ask me, is okay, so interest rates we don't know what's going to happen. But one thing that is happening that I think is really fascinating is that if you look at these big, I call them platform companies like Amazon, Microsoft, Apple, Google, Facebook, maybe to the lesser extent, people have built the internet on that. So if you look at like your phone, like I have my timer because I'm trying to stick to an agenda. If you look at the apps on your phone, like Spotify, I have Spotify, Reddit, CNBC, they all go through Apple. Like to get to Zach, Spotify has to go through Apple. And because of that, Apple makes a gosh darn fortune charging fees when you buy stuff through the App Store. Well, if you're Spotify, and I'm just going to use, I don't know the real numbers, so we'll just use fake numbers. Let's say you're Spotify and you make 10 billion in revenue, but 3 billion goes to Apple. 3 billion is a lot of money that you could save if you could find a way to not pay Apple. And there is a very big movement in the world right now to do what are called Dapps. Are you familiar with Dapps, Austyn?
I'm not.
Decentralized applications. So basically, Spotify is app. It's an app on the App Store you get from Apple. A lot of apps in there, and they have to pay Spotify. But using trigger warning blockchain technology, there's a lot of companies that are trying to come up underneath these big platform companies through decentralized apps and find a way to get to the consumer without having to pay the big platforms. And it has become like, it started out as a ripple and now it's a wave. It's not a tidal wave by any means. It's kind of reminiscent of the early internet. But when you read the stories of people who know what the heck they're talking about, people are really thinking like this type of technology could be the next iteration of the web. So like, for example, you started out with the internet and people kind of had forums and they didn't know what to do. And then they kind of came up with shopping and, Wikipedia. And so now you could go to the website as like a destination. And now, like with your phone, shoot, man, I went to Boston and New York, traveled on trains, planes, automobiles, Ubers, reservations. I never looked at anything but my phone. I mean, everything's on your phone. Your TSA pre-check, your airplane tickets, your vaccine passports now that they make you take in New York, all this stuff, it's all on your phone. So that was the next iteration of the web. The next iteration of the internet is looking like these decentralized platforms are really gunning to take over a big part of that. IBM is one of the absolute leaders in this technology, but it's wrapped up in a big company with a lot of like expensive dead weight. So anyway, this is, I'm getting way too deep into the weeds about this, but all that to say is in technology, the opportunity is just starting. It sounds crazy to say after the NASDAQ has been up 16% a year for the last 10 years or whatever the number is. When you look at world history, they're just going to say like 2000 to 2050 was the beginning of the technology age. Like it's not even started yet. So the opportunities are endless and there's super smart people all over the world figuring out how to make technology, make all our lives better and make a bunch of money in the process. So I think the opportunity in tech is just beginning.
Okay. I feel like I learned a lot. Got a little history lesson on my question.
No, yeah. Well, that's what you have to look at because that's the tricky thing is like, just because something becomes popular doesn't mean it makes money. So it's easy to say like blockchain technology is going to change the world. It's not easy to say, are we going to make more money with blockchain technology than we are owning a company that hauls away trash? Because companies that haul away trash, we know are going to be profitable, pretty much forever because they get monopolies in their market or, whatever, like a utility. But, there's more volatility there. So you kind of have to balance those two things out.
Maybe. I don't know. In the movie WALL-E, they didn't do a very good job hauling out trash. And then look what happens. Technology. They had that big space world.
I don't have anything. I got nothing on that.
I got you. Stumped you. We go watch WALL-E.
Because like the planet was trash, so they built amazing technology.
Planet was trash. Yeah, this is perfect. They had that big space world where they all lived in their chairs. And trash Transportation was out and obsolete, and tech was still in. Tech was booming.
I see where you go now. My wife and I, to this day, like if you ever go to the beach, and whenever I go to the beach, I have like a towel over my shoulder and then like a ball under my arm, and then like maybe a LaCroix in my pocket. Like I don't bring much to the beach, but then you get to the beach and there's a guy with like 4 tents, a barbecue grill. They brought cornhole, they brought enough food for 100 people and a fan. My wife always called those people Wallies. Like they bring one of everything. But then as I've had more and more kids, I started to become a Wally in certain situations. Like I went to a baseball game and I had a backpack full of every snack, sunscreen, like one of everything. So it's hard not to become a Wally.
You're just becoming a dad.
Yeah. I fought it for 10 years and now there's no turning back.
Oh, geez. I'm not excited for that day. All right. Well, let's get
not excited to become a dad. Being
not excited for
awesome.
carrying around
Austyn.
backpacks with sunscreen and maybe baseball mitts.
You don't have to become a dad. It's an option.
Extra layers of clothing and snacks are cool. I can bring snacks. All right, moving on. Let's talk about inflation. Let's talk a little bit about Social Security Administration's announcement last Wednesday. They updated that we're recording this on October 18th. So last Wednesday, they announced 2022 cost of living adjustment is going to be 5.9%, the largest increase since 1982, which is when Thriller came out. And that's when E.T. came out. And I don't know much else about 1982.
Like E.T.? E.T. always made me so uncomfortable.
I think I saw it once. I have no desire to see it again.
I think if you were like a teenager in 1982, as a real like brain melting movie. But when I saw it when I was like 13, I was like, I don't like E.T. He's weird. Yeah, I didn't like E.T.
I have no desire to watch it again. Not really my type of movie, no. I guess. I don't know.
No. It's a classic, though. They say.
It. Yeah, it is. Okay. It doesn't mean it's great. They could redo it. They were doing all the movies.
Let George Lucas remake it.
Yeah, that's what they need to try again with the new technology. All right, let's talk about COLA then. And then another fun fact. Sorry, I got in a rabbit hole with the year 1982 earlier. A gallon of gas cost 91 cents.
That's actually, 300% in 40 years? That's actually not like crazy inflation.
Not bad, but that would be sweet.
Yeah. Oh, is that my cue to go?
I don't know. You want to talk about COLA?
Yeah. Usually you have a segue. All right.
No,
cost of living. Basically, Social Security will pay you the cost of living adjustment for inflation. And inflation is high because the Federal Reserve is pumping trillions of dollars into the economy through bond buybacks. They have low interest rates. They're paying out advanced unemployment. Demand is through the roof. Supply is through the floor. And that's a recipe for inflation. So who wins? I always like to ask, there's like that Greek saying, like, who benefits? I don't know. Remember, it's kind of like the e pluribus unum, like you're supposed to remember that your whole life kind of thing. But who benefits from high inflation? I can think of two main people. High inflation very much benefits people with long-term fixed rate debt. So if you own a mortgage, like locked in at 2.75% or 3%, by the way, if you don't have a mortgage at 3%, you should probably refinance. Call us if you need a mortgage broker referral. We don't do mortgages. But if you have a 30-year mortgage and inflation, like just for example, doubles, like let's say you're paying $2,000 a month for your mortgage and inflation doubles. Well, when you pay your next $2,000 payment, you get to pay effectively half the money, right? Because money is worth less. So holders of long-term fixed debt benefit very much from inflation. And who's the largest holder of long-term fixed debt? The federal government in the form of Social Security payments, because they owe you $1,700 a month, or what do we see? The average monthly benefit will be $1,657. If they can pay you that with inflated dollars, that's easier for them to pay back. So a big part of this podcast, why are we all trying to become financially independent? Why do we want to accumulate wealth? Well, it's one of the main reasons is security. And one of the ways you can get security is that if grocery costs go up 5-10%, you can still afford your bills. If energy costs go up 5-10%, you can still keep the heat on. Yeah, it's nice to go on vacations. Well, if flight costs, by the way, flight costs are going up dramatically. If airplane ticket costs go up 5-10%, you can still go on your vacation. The way you combat inflation as an investor is you buy investments in things that can increase their prices. Who loses in inflationary periods? The people who loan money at long-term fixed interest rates. So I might have phrased that weird. If you if you lent money to me to buy my house, you lose in inflation because I get to pay you back. If you are a bond holder and you lent money to a corporation or government, you will lose in an inflationary environment. If you are the company that received the bond money to invest, you are most likely to benefit. So inflation is, we all love to complain about inflation. I personally love to complain about like the price of gas. I mean, it's just satisfying. The price of a Domino's pizza, satisfying. McDonald's is paying like $20 an hour, according to the sign on the McDonald's by my house. So it's fun to complain about inflation. But if you are an investor who pays attention to this stuff, there are ways to profit from inflation. You can buy companies that are holders of long-term fixed debt. So I'm not recommending this because you all know we drink the Dave Ramsey Kool-Aid. But if you can borrow money at 3% and invest it at 10%, like you can benefit from inflation. You can invest in companies that have pricing power. Like Coca-Cola, if inflation doubles, you can, instead of selling your Coca-Cola for $2, you just sell it for $3. It's really easy to increase the price of your product. However, there are some companies that don't have a lot of pricing power, especially companies that are in very competitive industries or very heavily regulated. So I'm not going to go into like the super duper details of which companies are best to invest in inflation. But if you do some homework and you do we always say investing is the 3 T's: time, temperament, and technique. So this isn't a situation where, knowing that we're in an inflationary period, put in the time to see what type of investments are going to do well, assuming inflation continues. So I feel like I could talk about that for 45 minutes, Austyn. So I better check myself before I wreck myself.
Okay. I appreciate it. And for those who want to learn more, for those who the cost of living adjustment will impact, we just put out our 2021 Social Security webinar addressing your Social Security benefits. You can find that on our YouTube page, on our Vimeo page. You can sign up for our marketing insights email at denverwealthmanagement.com, and the video will soon be on our website too. So more there.
Well, thanks for listening. Tell your friends, tell your mom, tell your neighbor.